So we got a few more people joining in on camera. That's cool. Don't talk about price. We talk about investment. Yes. I'm listening. I'm taking notes. Taking notes. Good morning. The investment. Yeah. All right. Cool. All right. Welcome aboard, everyone. This is Saturdays with Eddie. Today is Saturday, March 18. Once again, we are meeting to talk about options trading. That is in the stock market, basically leverage. I think that's what is that the right word? Leverage. Yeah, that's a commonly used term. So here's where you multiply. We don't just add, we multiply. So quick disclaimers here. This is educational session. It is not financial advice. If you cannot afford to lose the money that you invest, please don't. So just a quick warning that the potential profits are great. The losses can also be great. So always be cautious when you're talking about anything. This is not an overnight richness kind of thing. This is a continued discipline, a lot of discipline. So today's main topic is how do you stay, actually, let me remind myself, what's today's topic? I think it was, or is, oh boy, I forgot the title. Yeah, what do you really need to succeed as a swing trader? That's what we're going to be focusing on. Keyword there is to succeed. Whether you're doing swing trading, day trading, it probably matters, but not so much. The key thing here is what do you really need to succeed? Because that's, I think 100%, if I'm not wrong, 100% of you are in it for, 100% of you are in it for to succeed, right? It's not a hobby. Basically, those are the words I'm trying to find. Not a hobby. Cool. So is anyone joining for the very first time today? We want to welcome you, especially anyone here for the first time? Kelly Street. Hey, Kelly, say hello to us. Tell us what where you're coming from, what you're trying to get, where are you going? What do you need?
Hi, forgive me. I'm just recovering from the flu, but I'm from Savannah, Georgia, and this is my very first time. I'm know basic stuff about options, but not very much. So interested in trying to learn, so I can generate some income.
Yeah, you're looking for income. That's awesome. Yeah, they say that you need about what? How many sources of income extra on the side? About 7, give or take. Yeah, that's a number. I don't know who came up with that. All right, welcome, Kelly. And where are you today?
Savannah, Georgia.
Oh, okay. All right. Give me 4 hours. I can be there. I'm not going to be there. Yeah, that's 4 hours from where we are. I'm in Atlanta. All right.
Okay.
Welcome. Anyone
Thank
else? You're welcome. Anybody else who's here for the very first time? No? All of you are. Yeah, I think I recognize all the names. Cool. So let's build a quick agenda here. Here's how we're going to do it, because we have roughly an hour plus, maybe, I don't know. But let's do a Q&A. If you have a Q&A, we're also going to look and see whether there are any opportunities that we should take advantage of, in the coming week for the market. We're going to answer questions for those getting into options for the very, very first time. And by the way, this session is really for anyone, whether you're new to options or you've been trading options for a while. This is certainly something for you. So feel free to ask questions. There's no dumb question. You just need to ask it. We'll find some answers for you. There's a lot of every face I see here is very, very smart. So let's start with that. Anybody have a burning question or a burning topic that they want us to discuss?
Hi, Eddie. This is Bobby. I'm hoping that maybe today you can just re-explain the differences between doing a vertical
Mhm.
and a single. I took a trade on Thursday,
Yeah.
which was a vertical, but I'm still trying to understand what I did.
Okay. So we'll talk about a vertical versus a single. Is that right?
Correct.
Okay, we'll do that. And there's so many types of verticals, and there's only two types of singles. So we'll touch on that. Actually, that's a good way to introduce. So cool. Any other topics? Anybody who wants us to discuss? Or question? All right. Cool. Well, my Thinkorswim is firing up. By the way, I use Thinkorswim. Is anybody using anything different? Anything apart from Thinkorswim?
Hey, Eddie, I did have a platform question, Thinkorswim.
Sure.
So what I want to do is when I get into an options contract, I want to immediately have a stop in place.
Mhm.
And I try to do a first order triggers sequence.
Yeah.
And I guess my bid ask was too small. So as soon as I got in the trade, it did not execute my stop. So the trade went against me and I lost money. Is
Yeah.
there a better way to put that stop in place?
Yes, there is. So you mean to put it in after the fact, right?
Yeah, well, I'd like to do a order trigger sequence so it's kind of put in place, but what I was doing it manually. So I'd get in the trade and immediately come back and put a stop.
Mm-hmm.
So if it went against me, at least I would break even.
Yeah. I will show you a way of how to manage a trade. So I'll phrase your question as managing a trade once you're inside it, right?
Yes.
Yeah, let's do that. You've got a few choices that you can do for that, and that's actually quite critical because it's part of risk management. Yeah. So
Thank you.
sure, no worries. So managing a trade, that's cool. And then let's see. Patrice wants to know about how to exit the trade. How to exit the trade. So I'm assuming she already knows how to get into the trade. She doesn't know how to exit. Is that about right? Is it just any kind of trade, or yeah? Is there any kind of are you talking about spreads? Are you talking about singles? Let's see whether Patrice is going to answer that. No, okay. Well, we'll just do it in general. That's your question. I see Cheryl has got IBKR, which is Interactive Brokers. Interactive Brokers is a platform that they use. Well, it's used all over the world, but it's mostly in Canada. That's what they're using. I believe the reason is because Thinkorswim is not available in Canada. It's not available in most places outside of the US. So Interactive Brokers. So I do use Interactive Brokers every once in a while just because I have to teach using it every so often. So cool. And TradeStation as well. Hava Johnson says, she's here for the education. Welcome. And she's here. She has an account in IB, but not sure how to navigate that yet. Okay, cool. Yeah, she's asking for suggestions. If you have any links to any videos or tutorials that people with IBKR can use at Interactive Brokers, I haven't found a whole lot. Even on their own website, they have some very rudimentary things. However, what I would say is that the best way to use IB is on your mobile device. Unfortunately, they have a really good device. I mean, platform on their for the iPhone or iPad. Maybe they have one for Android. I don't know, but their desktop version is horrible. Kelly, what is the investment? The investment is 3,500. That is the investment at the moment. It's going to go up, but at the moment it is 3,500. What does it cover? It covers everything from fundamentals all the way to making your first dollar and making it consistent, right? We're not shooting for just $1. We're shooting for, with a few zeros behind that consistently. Fortunately, we can say that we are succeeding in that. So it's results based. Go to optionswitheddie.com. Yeah, more information over there. All right, let's see. Any other questions here? I'm going to take 2 more questions. Please show her how to calculate your target to exit a vertical spread. So Jennifer is looking out for someone. I'm not sure who she's looking out for, but that's cool. We'll look out for each other, and she wants to find out how to calculate a target exit on a vertical spread. Yeah, on a vertical spread. All right, cool. Hey, thanks, Tanya. Thanks and Dora for posting those links. Thank you very much. All right, cool. I think my Thinkorswim was fired up. I was waiting for Thinkorswim to fire up. So, all right. So I actually have a trade that I want to show. So Friday, was it Friday? Maybe Friday. Lost my train of thought. All right. So Bobby, your question is what's the difference between a vertical and, let me share my screen here for your benefit. The difference between a vertical and a single. So the main difference is that one has 1 leg, the other one has 2 legs. That seems kind of strange, right? It's a strange description. What would it mean 1 leg versus 2 legs? And I'm going to demonstrate what that means. I want to speak to the level of everybody who has, or anybody who has not dabbled in options. Can you all see my screen, by the way? Is anybody seeing my screen?
Yes, I see SPX.
Yes.
Oh, got it. Thank you. Thank you for the confirmation. I want to make sure I'm sharing the right thing. So good. So what Bobby wants to find out is how does she know that she is going to do a single or a vertical? What's the difference? What are the risks? It's a good comparison, I think, to understand from, once you've been trading for a while, or not even trading for a while, or in your learning journey, how do you decide which strategy is better for you, right? And I think I'm going to take that as the question. I'm going to take that as a question that she's asking. So I'm going to use my favorite stock here, which is Apple. I use Apple a lot for a lot of examples. Everybody knows Apple. It's a fruit company out over there in Silicon Valley. Everybody know it? No, you guys don't get out much, huh?
Yes.
Yeah, so Apple is a fruit company. You can see it's got the logo of an apple there. And they sell electronic stuff. Cool. How do we make money in the first place? I'm gonna start a little further back in order to answer your question, Bobby. And I'm doing this I know you know how to do this, but for the benefit of new people, I want to dial it down a little bit. So how you make money using options? Remember that when you are doing shares, you can buy the share at 155, right? This is Apple. Apple is, let me mute the sound. There's a lot of distraction in the sound. Very cool. Okay. So when you're trading shares, it's pretty straightforward. You buy Apple at 155. If you want to make $10, say you bought one share, you just wait, until the price goes to 165 and you sell it at 165. And so remember, you bought the low, you sold it high, 155 to 165. The difference is $10. That's how much you make. But if you were trading options, then you can go over and buy just one options contract. And just going with an arbitrary date here of 28, you can probably spend $820. And if the price goes up by $10, that is Apple goes up by $10, then in this particular instance, you can make a ton of money. Where's my calculator? I need a calculator here. Yeah, you can make $570. Actually, I did not need a calculator for that. You can make $570. So you can see the difference here, right? For a few more dollars, or even less than you would spend on shares, you can make a lot more. How did I come up with $570? It's because if I bought actually I wouldn't buy the 152, I'd probably buy the 150 strike. And if Apple stock went up by $10, then I would make 0.62 times about 10, which is $6.2 in premium. We know that one options contract represents 100, so that 6.2 would multiply by 100. That would be $620. Does that make sense? So that's just like options 001, I guess. It's not even 101. It's pretty basic. That is a single call, right? That's a single call. So when we do that, that is single, right? That's a single call. So you would be spending $985 in this particular case. Verticals, on the other hand, are when you have two legs. You're buying something and you're selling something, right? What is that something? That something is a contract, obviously, right? It's either a call or it's a put. It could even be both. So there's two legs, and you can employ different strategies. I'm going to go with a credit strategy here, Bobby, if that's okay. Yeah, is that cool? I'm going to go with the credit strategies, and I'm going to go with an instrument like SPX. That's the one where we most commonly buy and sell. Now you can buy and sell using any security, but this is a very, very popular one. And I'm just going to go with Monday's date, which is the 20th, right? And we're going to do a vertical, right? A vertical. So I'm going to do a trade here that I'm not explaining from start to finish just yet. But let's assume that we think that the price of this security, I'm going to do two things. It could possibly go up, or it could probably trend down. So two possibilities. So let's build two theses here. If the price tends to continue going upwards, then could we safely say that we don't think that price is going to come down to 3,900 or 3,875? We could build a thesis around that, yeah? So if we build that first thesis that price is going to remain above 3,900, I'm just picking an arbitrary number here. There's a method to the madness, right? There's a better way of determining what strikes to choose. We're not going to go over that today, but for example purposes, we're going to assume or we're going to theorize that the price is going to remain above 3,900. That's our story. If that's what's the story is, there's several ways that we can attack that. There's several ways that we can take advantage of that. We could buy a call, right? We could go to the chain, right? Go to the chain and decide that we're going to invest in at the money contract of 39.15. We would be spending $2,800. Okay, $2,800 on a single call, and we would expect that we would make money when the price of the underlying increases. However much it increases, we're going to multiply that by 0.51 cents times 100. That's how much we're going to make. That's one way to do it. Another way to do it would be to sell a put. Do we sell puts naked? Let's see if there's any feedback on that. Are we in the business of selling puts naked?
No.
No,
No. No. That's right. Patrice, fruit company, not food company, fruit company. Yeah. So we don't sell puts, naked puts, right? What would that look like if I were to sell a naked put? If let's just assume the broker would let us do that. Say my name was Bank of America. What would that look like? Right? It would mean that I would be able to click on the bid column for 3,900 because my thesis is that price is not going to trend downwards. Instead, it's going to trend upwards. So I can sell, if the broker would let me, I could sell the 3,900 put just by itself. That would be called selling naked. And what would happen? Right? What would happen is that the broker would deposit $1,860 into my account. And for as long as SPX, or that security, remains above and closes above 3,900, I get to keep the 1,860. Yeah, that'd be a really nice thing. We'd do that every day if we could. However, you cannot. The risks involved are too great, too high, right? Subject for another class. So what we do is we buy insurance, right? We buy insurance. And how do we do that? It means that we have to buy something because we don't own the underlying. We have to buy something in order for it to be covered. So it's not a covered call or covered put. We're just covering our base here, saying that we're going to sell the 3,900, but we have to buy something in order for that to be balanced, so that it's not a naked sale. So what I would do is that I would go up and say buy the 38.95, which is that one. And all of a sudden now, if you look at my order screen here, I am selling the 3,900 and I am buying the 38.95. Right? Let's look at the chart to see how that looks like. So I sold the 3,900 and I sold a further out of the money because 3,900 is already out of the money. Yeah. Yeah, it's out of the money. So I'm selling I'm buying a further out of the money contract at 38.95, and the net is so I'd be collecting $1.75. Now these numbers are kind of high, on the higher side, considering that we don't have updated prices. It's a weekend, and I got this message from TD Ameritrade that maintenance in progress. So these numbers aren't really real. They're not real. But let's assume that Monday morning and we are getting credit of say 175. That's what it says it can give me. That is a vertical. That's a vertical. Bobby, I'm going to let you rephrase your question here. If is that making sense so far, Bobby?
yes, definitely. It's making sense.
It's making sense. So there's two legs. Leg number one is I'm selling one, I am buying another one. And the result could be two ways. It's possible that I could get a credit, depending on which one I'm selling and which one I'm buying. I could get a credit, or I could pay a debit. And when it's a debit, it means you're paying. Money is coming out of your account. You need that money inside of your account. When it's a credit, you don't need to have that a whole lot of money. What you do need to have is the difference, or the width of the spread. In this case, it's 5, right? I know it's 5 because that's the difference between 3,900 and 38.95. It's a 5-point wide spread. So to execute this trade, you would need $500. And then right out of the back, broker will pay you $1.75. And if the price remains above 3,900, you get to keep the 175. Or you could close that position. Remember, this would be a sell high, buy low. So you'd have to buy it back lower than 175. The typical amount of money that you get in credit from credit spreads is somewhere between maybe 60 cents and $1.50. That's the average. Yeah. So I teach strategies on what is a sweet spot for credit spreads, what is a sweet spot for debit spreads as well. The difference between that, I have a cheat sheet that explains the difference between that. So hopefully that answers your question. But I don't want to go too deep because I think there's a lot of people who have not dabbled into options just yet.
That helps. Thank you, Eddie.
You're welcome. You're welcome. Jennifer says, show her how to calculate your target to exit the vertical spread. I think we talked about that a little bit. So in this particular scenario, if you're getting a credit of 175, remember you sold something you do not own, right? So in order for you to completely close the trade and lock in your profit and you're out, close the risk, you'd have to buy this back, right? Or buy the equivalent. Remember, to close this, what we do is we turn this from a single order into a first triggers OCO. And we're going to create the opposite order. Notice that now we're buying the 3,900 and selling the 3,895. We're doing the exact opposite of what we did to enter the trade. This was a sell to open. This is a buy to close, right? So if we bought it at 175 and we want to make 75 cents, could we buy it back at $1? Yeah, we could, right? Since this is happening tomorrow, maybe we can do a GTC on this. I would never recommend that you buy or sell anything on the weekend. Don't do that. We do not do that at all. Okay. And then you'd have your stop loss. We're going to talk about that maybe later on, but I want to show you something here. I'm going to send this. So I just sent that trade in, and now it's sitting here. So you can see it's waiting. It's waiting to close. The MAC is the current price. That's how much this spread is valued at. So if we get in at $1.75, meaning we get filled at $1.75, then that's how much we would receive. And then we would buy it back at $1. The profit on that would be 75 cents. So Jennifer, to just to comment on your statement there, there's so many factors that go into what is your target exit. What's your target exit? But we do have some rules. I do have some rules about what those should be based on increasing your probability of success. That's what it's all about, right? That's what it's all about. Let me give you a scenario. We can sell these at 175 and buy it back at 150, and you would make what, 25 bucks in the process? Yeah, you could do that. But is that a good strategy? Is that a good use of your money? And the answer is no. No, you want to make sure that you maximize your dollar. So we talk about ways of how to use a small account to make a lot of money. So there's a lot of waiting. There's a lot of waiting when it comes to option strategies. You don't want to be trading every day, or if you're trading every day, you better be making a lot of money, or have a strategy that actually helps you with that. Okay. Let's see. Jamie wants to know how to manage a trade. So I got just a trade for you. I got a trade for you here. Let me cancel these. Oh, by the way, there's two ways to cancel a trade, right? You could come in here and guess what the X would do. The X would close out that particular leg, right? You would close out that particular leg. So in this case, because I don't want to just cancel the sell, I want to cancel both, and I'm not already inside the trade, I could just close that. Because it's a vertical, it should close. Oh, wait, I was selling. Made a mistake. I was selling to get in. So there we go. Yeah, selling to open, buying to close. All right. So if I go to my monitor, there's nothing here. So Jamie wants to know how to manage a trade. And I've got this trade here, right? So I purposely left this trade open so I could use it to teach. And I did this in both my live and also in my paper trading. So this is a particular trade that I did that I sold. I bought SEDG, and my plan was to sell it at $27. So you can see that my P&L here is actually negative 1,045, right? In live, I wouldn't let this happen. I would not let this happen. So the live, I actually did get stopped out. So this is a perfect example for risk management. If you don't have a stop loss, this is what happens, right? It spirals out of control. And now you're looking at a huge, now you're looking at a huge loss that would, this can destabilize any account, right? Big or small. $1,000 is a lot of loss. But it's working out perfectly here because Jamie wants to know how to manage a trade. So I entered this trade without a stop loss. So how do I add a stop loss to it? Let's assume that this instrument, the instrument that we are referring to is SEDG, right? Which is that one, right? That's the instrument we're referring to. And notice that the thesis was that price was going to, go up, and instead what happened? It went down. So, but it is recovering. We can see that it's recovering. So I'll let it stay. I'll let that one stay in my sim. In my live, I don't let things go to negative anything, negative 1,000 anything. Not cool. So how do we do stuff with it? I'm going to actually close this, and I'm going to do something else, right? I'm going to cancel that order because I'm going to cancel this order, right? Now I have nothing, but I'm inside a trade, right? I'm inside a trade. I'm still +1 on the 295 call. I'm still +1 on the 295. So the trade is open. So Jimmy's question is, how do you manage this trade? Let us assume that Jamie has evaluated everything. Jamie, you still with us? Still with us?
Yes.
All right. Let's assume that you've evaluated anything and you've decided that, you know what, 1155 is great. You're not feeling very easy. Maybe you have a higher risk tolerance, and you've decided that if it drops down, if the value drops down to say 1,000, where is it? It drops down to 1,000. Did I say that right? Drops down to 10. You want to get stopped out. You're just going to say, you know what, this is not even working. It's not a good trade anymore. Gonna stop myself out. Yeah, you with me on that, Jamie?
Yes. So I know how to put a stop in.
Mm-hmm.
I guess my question would be, once it comes down into a zone and I confirm that it's leaving the zone,
Mm-hmm.
I want to take the trade and I want to put a stop in at the same time. So if I put the trade in, say my premium's $20,
Mm-hmm.
I want to put a stop. Once it's going in the direction, I want to put a stop in at $20. So once it turns against me, if it does, it'll take me out of break even.
Yep. Okay. The example we are going through here will demonstrate something similar to that.
Okay.
So walk with me here, and we are already inside the trade, and that thing that you did not want to happen has now happened, which is it's going against you, right? So we'll see how to prevent that from happening.
Okay.
Right. So I'm assuming here two things. Well, one thing, that you entered your price target was met, entered the trade, but there was no stop loss and there was no take profit. Shall we assume it on? Shall we go with that basis?
Yes.
Yeah. Okay. So we'll do two things. We'll set a stop, and at the same time, we'll set a take profit. Right. So my trade price on this one is $22. So in order to make profit, I have to sell these anything above $22. Right? Anything above $22. The current price is $11.50. That's how much it's worth. So I can't put a stop loss of say 18 at the moment. I cannot do that, but I can set a stop loss for less than what the current mark is. So that's what we're going to demonstrate. The way that I would do that is to right click on this instrument, and I would create a closing order, and immediately it says, go ahead and sell these. And the price at the moment that it's thinking is 10.90. And I say, yeah, that's fine. Not a big deal. However, what I want to do now is I want to manipulate this order and make it into two pieces. Yeah. The way that I will do that is I will change first from single order. And I know you talked about a fast trigger sequence. but you're already inside the order. So it needs to be just OCO. Okay, OCO. Now, once I do that, then I can duplicate this order and manipulate it. Both of them are sell. All I did was just copy that leg over into another leg here. And I'm going to call this one my take profit. So let's remember what we did. We we bought this at $22. So we have to sell it higher than 22 in order to make any money. So I'm going to go with my original plan. I'm going to go with $27. There's a reason for that, right? Because I want to make $500 on that. The only way I can make $500 on this trade is if I sell it for 27. Remember, I bought it for 22. If I sell for 27, the difference is 5 in premium. If you multiply that by 100, that's your what? That's your $500, right? And then I want to stop. I want to make the next one a stop. So I can do a stop here and say that if this goes below $10, then go ahead and put a market order to stop out, to close out the trade. I would then confirm and send. And I have 2 orders here. So I've just added a bracket order to an order that is already existing. Do you see that?
Yeah, quick question, Eddie.
Yep.
So would you do a stop limit or just a stop?
You can do either.
So if you do stop, won't that take you out of the market price? You're not really sure what it's going to do.
Yep, that is true again. So if you wanted a controlled stop, I'm going to show you 2 more ways that you can control this stop. So the better way that you're describing, Jamie, is instead of doing a stop, which triggers a market order, remember the stop is going to trigger a market order. What do we know about market orders? Market orders, you have no control, right?
Right.
It could sell at $2. It could also sell at $30. It's either or, right? Or anywhere in between, or it could just sell at $10, depending on the liquidity of this stock. What is the best way to know how much it's probably going to sell it for? I'll show you a trick. If you go over to the options chain and you look at the bid ask spread on that particular contract with 295, and that was a call, it's trading anywhere from 1090 to 1220. More than likely, a market order would trigger on this lower side, whatever the bid is, actually whatever the natural is, right? That's what it would not more than likely go for. So usually the natural is what it goes for. So you have to be careful and see, keep a close eye on what the natural is and understand that if you do get stopped out at 10, then, whatever the natural is at that particular moment, that's what it would more than likely get you out, because the idea is to get you out immediately, right? So to control, we can add a stop limit, right? So stop limit here says that I want to be stopped out at, say, maybe 10 is when I want to trigger the limit. But how much do I want to, the stop is 10 and the limit is, at 10, I want to be stopped out. But how much do I want to sell it for? And I'm going to say maybe my pain point here is actually 9.7. Let me explain what this means. Why 9.7? Why not 10?
Because of the spread.
Not just that. At 10, you're telling the system that once the price reaches 10, go ahead and issue a limit order. Do you think the price is still going to be 10 or is it still going to be trending downwards?
Yeah, it's moving.
It's going to be trending downwards more than likely, right?
Mm-hmm.
So what you do need is some sort of distance between the limit itself and the stop. If this limit is too close, say this is a slow moving, if this is a slow moving, stock, then 30 cents might be a good, 50 cents might actually be more appropriate. But here's the danger. Let's say there was a market event that caused a sudden price drop. It can blow right through your 10 and right through your 950, in which case now your stop is never going to execute. That is the risk. That's the additional risk. You with me on that, Jamie? See where I'm going with that?
I do. So, I mean, there's risk on the market order and the stop limit.
Absolutely. So the difference here is, do you really want to get out at any cost? Yes. Then you use a stop, right? And you're hoping that the stop will stop you out within a reasonable range, but you're never in control of what that range is. On the other hand, if you want to use a stop limit, you're saying that I know this stock doesn't move that much, and right now liquidity is, give or take. So you are willing to stop at maybe a little lower than 10. You could also argue that, you know what, this thing is just fluctuating. Let's go with one other scenario here. This thing is just fluctuating back and forth. So you know that if it hits your limit, if it hits your stop over here, you know what, I don't want to bargain. I don't want to sell lower than that. I actually want to sell higher. So you could say that I'm not comfortable with these bounces here, but it seems to be bouncing back and forth. You know what, I'm going to say, just get me out of 1050. It means that it's going to wait for the price to come back up to 1050, and you're like, I'm out of here. Don't trust you anymore. That's it. Taking my losses and coming out. Does that also make sense? So you see, you can go two ways there, right?
Yes.
Yeah. I mean, you could say that, you know, well, this thing's just going down, so let's lose another $50. Or this thing is just bouncing around. If it hits 10 again, I'm going to take the next best thing. And you say that the next best thing is going to be, say, 10 and a half. That's likely to give you a better deal than 10, obviously, right?
Right.
There's one more way. There's one more way we can do this, right? There's one more way. What if we decided that if it hits 260 again, I don't know, this is not a good deal. If it hits 265, let's say it hits 265, right? If it hits 265, can I build an argument that I want to get out of the trade if it hits 265?
Do a conditioned order.
So we could do a conditional order, right? How do we do that? The way to do a conditional order is, I'm going to delete this. And I'm going to go back here to monitor. I'm going to start over, create closing order, do a sell. I'm going to make it an OCO. So I've still got that, but I'm going to duplicate this. And remember that we said that we're going to take profit at about what, 27? Is that right?
Yes.
We're going to take profit about 27, but this time we're going to stop. We're going to stop ourselves out if the price goes down to 265. How about that?
Okay.
Whatever the mean is at 265, that's what we want to do. And that's what we want to tell Thinkorswim to do for us. So watch my screen here. And on the right side, as I mouse over this second leg, there is this cog wheel. Do you see that?
Yes.
I'm going to push one time on it, and it gives me this really strange dialogue. It's very confusing, but well, maybe it's not confusing, but it's a really busy dialogue. How about that? Let's just call it busy. Yeah.
Right.
First thing I want to do is I want to set what my conditions are, and I'm just going to click on the bottom here of just below the word symbol. By default, it's going to give me the instrument that I'm working with, and then I'm going to click under the mark and under the method, and it's going to default to mark. If it's anything else, make sure that this one says mark. Okay. And then I want to set my trigger to less than or equal to something, right? So if what is that something that we have decided? We decided what, 265, is that right?
Yes.
So we decide that our threshold is 265. Remember the default there is 0, which doesn't make a whole lot of sense. But that's 265. We're saying that these are the conditions under which we want to stop ourselves out. On this symbol, when the mark reaches to less than or equal to 265, we're going to do something. What is that something? We're going to sell. Follow my mouse. We're going to sell. The price rules are going to be a limit, okay? And we're going to we're going to link that limit not to the man or manual, but we're going to link it to the mark, right? So change this from man to mark. And now that has changed, and our time in force, we're going to change that to GTC because we don't know when this is going to execute, right? So we've changed our timing force to GTC. We've linked the limit to mark. Yeah. I want to
In
see
the past, I've changed the mark to a bid and put a offset in there, but you recommend doing mark.
You could do that. Well, that your argument there would be on what the bid was, but you don't know what the bid is, do you?
No, that's
Yeah.
why I put an offset.
Yeah. So you could offset here, and the offset here is based on what you chose. If you chose what the bid was, I mean, if you linked the limit to the bid, then your offset would be based on the bid. But now we are linking it to the mark, meaning 265, and we want our limit offset here to be based on off of that mark. So do we want maybe plus 50 or plus 20 or whatever it is? Now, let's also understand what this limit is. This limit is, what this offset is. The offset is actually, we are offsetting this from the mid of the bid and the ask, not the mark, right? So if I want to say, have the upper hand here by about 20 cents, right? Then I'm saying whatever the mid is of the bid ask for the 265 strike at that moment, whatever that medium is, go ahead, add 20 cents to it. That's what I want to sell this at. Make sense?
Okay. Yeah.
But if you just want to take the default and take the mid, then you just leave it at 0.0, which is what is the most common way to do this. And you would set it, you'd leave it at plus 0.00. You're saying that I just want the mid price of whatever that is. Remember, this is not an ideal situation for you. This is your loss. This is your risk management. So you just want to get out at a decent price, right? So then what would I do? I would push on save, and notice now this line here has changed, right? I am selling the 295 strike, the call, but the link is the mark, and it's plus or minus 0, which is great, and that's fine. Now, why is this grayed out? Why is this not possible? It's because all this must be the same. All this must be, I can't have one day and one GTC. So the minute I change this to GTC, I want you on watch here. Now I can send it. We good on this?
Yes.
So you just learned several ways to manage the risk on an existing trade that did not have a stop loss or a take profit. So I'm going to push confirm and send. I'm going to watch here. We've got two legs. We're selling. We're taking profit at 27, or we're getting stopped out. So if essentially what you did here is you calculated a stop out at what is it, at the mark of 265. Could you do the same thing with your take profit?
Yes.
You could do that essentially, right? We've just seen how to do that. And
I'm sorry to take up so much time, but what if there's a big news comes out and it just blows right through 265? Will it still take you out?
your SOL.
Ooh. Okay.
You understand what SOL is?
I think I do.
Yeah, we're not going to spell it out. So yeah, there's risk, and this is the market risk. Yeah.
Okay.
And what good would there be if all we did was just take profit? That'll be the nice thing, but the reality is that there's always risk in all of this. So it's man against machine. It could blow right through 265, in which case, now that would be your new limit sell. That'll be your new limit sell. So.
Okay. Well, thank you, Eddie.
Yeah, you're welcome. That was a good question. Lots of information over there about how to manage that. Manage what? Manage trade. You're already in. Yeah.
Eddie,
Yeah.
Can you show me the natural again? How you found the natural for that trade that we just looked at?
I actually don't know the natural. The way to, you can just click on it. If I think it was that was the 295 strike. Yeah. Am I looking at the right thing? 295 strike is, if I click on this, if just by clicking on the ask column, I'm watching down here. Do you see down here where it says mid and it says
Yes.
natural?
Yes.
Is that your question? I wonder, is that what you're asking?
Yes, that's what I'm asking. So once you're in a trade, doesn't it change to it changed from natural to something else?
No, but it's possible that this is going to be flipped. Sometimes the natural is less than the mid, in which case the
Okay.
natural would be here and the mid would be over here. So let's see something that whether it's flipped. I'm going to click on that. I'm just going to click. No. So the price is trending upwards. That's what this is kind of telling me. Let's go to another symbol here, like Apple. Just going to click on that. All right, let's see whether on the. Anyway, I'm trying to look for an example where the natural is on the left side. Tanya, you do enough of this. I think you will occasionally see, actually more times than not, you will see where the natural is actually less than the mid. So, but your question was where to find the price point about the natural, right?
That's correct. That's
Yep.
what I needed. Thank
Okay.
you.
Cool. Let me look at my other questions. Patrice wants to know how to exit a trade. I think we just demonstrated several ways. Patrice, tell me, are those enough ways to know how to exit a trade? Let me watch the chat. She had posted the question by chat. I don't see a question or answer. All right. Hope.
Hi, Eddie. I think
Yeah.
my issue is like whenever you make profit, it's there, but I don't know how to keep the profit. So I'm waiting basically the 45 days. So how do I keep the profit and not just have it go away after, with the time?
Okay. So the way you enter your trades is very, very important, meaning that if you don't have a take profit order, then you will never be able to take profit, right? So my question back to you is, when you enter your trade, do you also put in another order to take the profit?
If I'm doing let's say a vertical, I'm entering let's say it's a call, I'm entering the call, I'm entering the 2 sell orders, but I'm not, am I not entering the take profit order? Is there something else I should be doing?
Well, if you are already entering those 2 orders, then you're doing the right thing. I think your question here is that, if you allow me to rephrase it here, is that you've got your order in for that bracket, for that vertical, whatever it is, the price is reaching there because it says that you're in profit, but the order is not closing. Does that sound like what the problem is?
Yeah.
Yeah. So price, you're seeing that price has reached your target point and it has not executed, does not filled.
Right.
Okay. So common problem. In that particular scenario, with especially if you're using think or swim, then the most common scenario is that the price that you're seeing is the mid, right? Is the mark. But the natural is what price needs to arrive at in order for the system to successfully sell it. But if there's enough liquidity, then that natural does not really matter. The mid will work just fine. But in a low liquidity environment, especially for that particular strike or that particular strategy, then the natural needs to be at the price where you're selling at or where you're closing. Does that help? So now that you know where to look for the natural, you can go in and do a cancel replace on your. You can go in and do a cancel replace on your trade and watch what the natural is, and you get out within seconds. So.
Okay, that makes sense. Thanks, Eddie.
Sure. Mm-hmm. All right, good deal. Hava wants to know that what are her options to get approved so that she can implement the lessons. You don't have to be on Thinkorswim. So we have tons of students that are not on Thinkorswim and they're still using the program or the coaching. The way that I teach in class is not really platform specific. Even though I use Thinkorswim to instruct, I will give examples in a way that you can be able to execute them in any platform. Notice, by the way, when we did an example with Bobby, I did not actually go to spread vertical. I stayed on the single, right? I stayed on the single to build my spread. I just need to know what I need to sell and what I need to buy. That's important. So for instance, I'm talking about spreads. If I wanted to do a 5-point wide spread on Apple, right? Remember by default, if Apple has got 1 point wide spreads. Is that right? Yeah, they're 1 point, but I don't do 1 point wide spreads. So if I wanted to do a 5-point and I did not have Thinkorswim, I would need to know what I'm selling and what I'm buying. So let's do a credit spread example on Apple, right? Credit spread. So to do a credit spread example on Apple, remember the short leg is the one that needs to be what? Closer to the current price, right? Closer to the current price. So if I want to sell the 158 and buy the, let's make it a 5-point wide plus 5. So to sell the 163, that would be a call credit spread. My argument here would be that price is trending downwards. So I'm going to sell the 158 and I'm going to buy the 163, right? Let's do that. So if you had interactive brokers, remember when you're selling, you go for the shortest expiration, yeah? When you're selling, you go for the shortest expiration. So let's do that. So I would go here to March 24th. And I want to sell, we said we want to sell the 158. Well, we don't have a 158. So I guess what? I'm going to sell the 160. Okay. And I want to make it a 5-point wide spread. So I'm going to go buy the 165. So I'm going to go here and also buy the 165. That makes it a 5-point wide spread. And we're going to collect 58 cents. So I just built a vertical and I'm still in a single. The way I achieved that was by holding my control key before I pushed buy or the ask. Maybe I should get you off mute. Let's see. The question about approval specific to getting a margin account on and the managing a trade was awesome. Thank you. You're welcome. You're welcome. So your question is.
I've unmuted. Thank you.
Okay.
So hi everyone. My question was that I got denied my margin account through Interactive Brokers. So I don't know how to navigate that because I want to get approved so I can do options trading through Interactive Brokers here in Canada.
So do you need margin in order to do options, or can you not do it with a cash account?
I believe you need to have a margin account to do options and shorting.
If you're shorting, yes, you do have to have margin, but we're not shorting. We're not shorting shares.
No.
Are you able to buy just like a call or a put?
I am not certain because I was just setting up my account recently.
Got it. Okay.
Thank you.
I may not be able to answer your question fully because I don't know what the rules are for interactive brokers and approving margin accounts. Usually margin means that even though the account is called or is of the account type margin, it does not mean that you're borrowing money from them. However, because it is a financial instrument where you could potentially borrow, means that there might be some fiscal requirements, like maybe a certain amount of money inside of the account, or how you answer the question in terms of income and source of income. At least on the US side, that's what they ask us. They ask us, what's your net worth? What's your continued source of income? What is, how do you plan to use it? What's your experience? That's a big one. I think your best bet is to give them a call. Talk to a human.
Yes, that's what I'll do. Okay, thank you so much.
Yeah, talk to somebody over there. I think that would be the best. Then you'd be hearing it from the horse's mouth.
Thank you. I appreciate that.
You're welcome. Cool. All right. All right. So we found that answered enough questions. So let's talk about how do you actually stay successful in this environment. The way that you stay successful in this environment is by several ways. It's not just one thing, and that's the key that I wanted to hone in on. Is this is an environment that is showing huge ups and downs. If you look at the S&P, for example, in the last few months or even few weeks, it's kind of we've stayed in the same area. We're just going up and down, up and down. And if I go back further, maybe 18 months, it's about, stories the same. It is not like it used to be. I'm going to go here to a 3-year. It used to be that you just throw something at the wall, you hope it sticks, and usually it does, and usually did. And you just keep going up. But somewhere around this point, which was 2021, I want to say, 2021, 2020. Yeah, we started going down, went down and stayed down, never came back up. Does that mean we're going to stay there? No, that's not what it means. Historically, over the last many years, we've tended to be like this. I believe those days are coming back. Tomorrow, next week? No, I don't think so. But, in due course, I am generally more positive about the market. I believe that the economy it just gets healthier and healthier, at least the US economy. So how do you stay solvent? How do you remain successful? My opinion, this is just my opinion, I think it's proven out, is that you have to have superior risk management. That's my story. You have to have superior risk management. It means that you have to know, first and foremost, where your target profit is and understand that it is not necessarily going to happen. So you have to find trades that meet your minimum requirement. You call the shots. You decide. You get to decide how much you make. Obviously, the market is going to tell you what it is capable of, right? But you get to decide what a good trade is for you. So we talk about an A+ trade. We talk about an A trade, and you want to be sure that you're taking more of those type of trades and less of the ones that are just borderline, right? In other words, you're being picky about what you trade. Means you're not going to be trading every day, a lot of waiting. Risk management is about keeping what you make. So Patrice just told us that sometimes she sees profit. I'm sure she's not alone. Sometimes you see profit and the system doesn't give it to you. It ends up going away somehow. Or by the time you figure out how to close the trade, it's dried up. Maybe you were $300 up at one point. Now you're just down up $100. Means that you've essentially given back, quote unquote, $200 in unrealized profits. How do we keep those? We need to be able to lower the expectation just a tad bit. So it's a very humbling moment, and I think it is necessary for all of us that when we see a reasonable amount of profit, we take it. Yeah. a reasonable amount of profit, we take it. So what's reasonable? That's I think that's subjective, right? It is subjective. For me, reasonable could be 500. Reasonable could be 1,000. Reasonable could be 100. Doesn't matter, right? But what's reasonable? Reasonable here is also relative to what the market is doing. So, for instance, if you see that your position was up, say $500, and now it's starting to go down, it is not coming back up to that 500. It is now at 300. Would 300 be reasonable? Yes. Yeah. What if there was a sudden market movement from, up from the 500 and you thought you were on a roll and now you're down 500? You're exactly opposite of that. And, things are not looking so well, but you've not hit your stop loss. Maybe you had a couple contracts and now things are looking up and you're now down to break even. Is that reasonable? Again, the answer is yes. Right? Did you make any money? No, you just broke even. Means that it's like you never traded that day. You only paid commission, right? So this has to be something that is driven not by emotion it can be by emotion. It has to be the numbers. The numbers are what have to drive you. So understand that, for one, you're in this to make money, not to lose money. So when you're up, you take it, right? When you're down, you cut the loss. You cut it quickly. And here's why. We understand that 70% or rather traders, most successful traders, that is traders who've been trading a long time or consistently and all that, their success rate is about 70%. Yeah, that's a number that's been thrown around. I don't know that they've actually done an accurate poll because they haven't asked me. I don't know. They haven't asked me yet. But the numbers that I see thrown around is that 7 out of 10, is the success rate. It means that 30% of the time they're losing, right? They're cutting the trade. The difference that makes them successful is that on that 30% where their trade does not go according to plan, is that they take a small loss. Very, very important. It's important that you be a good loser. A good loser. A good loser means that you're not losing $1,000, you're only losing maybe $200, right? Because that 1,000 is going to destabilize you. It's going to take 10 more trades just to get there, or 2 more trades or 3 more trades, positive trades to get there. So if you can control the losses, meaning that the 30% of the time that you're not winning, you are only losing us a little bit, then that is the way you get ahead. Because again, by definition, most successful traders win about 7 times out of 10. Does that make sense? I want to invite a discussion on that. Anybody has thoughts on that?
Eddie, what is your success rate?
I think I have a really good success rate, maybe better than 80%. But I'm also very conservative. Very conservative. I also have a problem with risk management. That's one of my biggest weaknesses. Watching trades go negative, and when they go negative a lot, and then I have to work twice as hard to bring them back to positive. So that's a weakness that I know that I have to work on. And the way that I've worked on in the last 2 years is by stop loss. That's why I sing about stop losses all the time. Stop loss is that's it. The reason I like stop loss is because it removes the decision making from me, right? It removes the decision making from me, given such that I don't have to make that decision when I'm losing money. The system just says, dude, you hit your stop loss of 2.5, you're out. And I'm like hands off, and I'm saying, okay, I'm out, right? So a $250 loss on a trade prevents me from losing many times about About $1,000. So I look at it as though, you know what, I actually kept 750. Yeah, that trade that cost me 250 actually saved me from losing an additional 750. Yeah, one of my rules is that I can't be losing $1,000. Four numbers, four figures. No, that's way too much. $1,000 is a lot of money to lose. It takes way too much to make it for you to just lose it in 30 minutes, 40 minutes. So I actually don't know whether 80% is correct for my success rate, but I want to say that I have a high success rate. Yeah. And the way I know that is because my account or my portfolio is on a positive traction. Sometimes it goes for a few weeks, just kind of, plateauing where it's not moving up, it's not moving down. But in general, on my measurement, on my scale of measurement is where I start at the beginning of the year and where I end up in about November when I stop trading, it is usually up. So I would say that I meet my goals. Does that help, Dora?
Yes, thank you.
And to add to your point, Dora, is what's not measured or what's not tracked is really hard to figure out, right? So if you're not tracking what your sale or what your growth is, then it's also hard to figure out what your percentage is or what your growth rate is. The best way is, well, actually, the natural way is to look at your portfolio. If you started off with 5,000, are you still at 5,000, or have you grown to 10, 20, 30,000, or are you down to 300? Right? That's a good way to tell, right? For most people, I think that's how they tell. That's how they tell. Yep. So yes, yeah, thanks. That's right. You have to. One of the things that I teach is the trading plan that evaluates, one of the section evaluates what my strengths are and what my weaknesses are. So my main weakness, if I'm to open up, I've got several weaknesses. One of them is patience. Yeah. I don't have patience, and that's a bad trait. So I need to be more patient, meaning that let my trade work. A lot of times I call my trades correctly because I've spent a lot of time on these charts. I've spent a lot of time, so I'm able to work with. I guess that's a strength. I'm able to work with price action, but I don't let my trades go all the way to success of multiples. Right? Many times I'm like, got $700 in the bank. That's good for the day. I'm out. But if I usually wait, especially on my futures trade, if I wait a little bit more, maybe 30 minutes, 40 minutes, that's what I'm talking about, I more than likely would be up 2 times or 3 times as much as I make. So that's a weakness for me. The risk management, I'm getting better at that. So, but I have a whole section on trading plan that talks about that and what you can do to help yourself. Cool. I think a few more people have joined that I had not seen. Anybody, by the way, who's got a question? If you just joined us late.
Yes, I have a question.
Sure. What's up?
This is Olga from Japan.
Welcome.
I was listening to what you were saying a minute ago. I think, like, I struggle with that too, and the problem that I have is like whenever I buy a put or a call, even though, let's say if I buy and it's going up, at one point it would tend to go down a little bit, and that way I panic. It would tend to go down a little bit, and then it will turn back up and go back to the direction it took. And so I guess my question is like, how do you figure out, okay, when it's turning around, or like, when do you really decide and know that, okay, right now it's turning around, or it's just doing that funny turning around that it does and then go back up?
So I'm thinking here you are trying to day trade. Is that what you're doing, or are you doing swing trade?
I did swing trade for a couple of days and it did not work for me. And for some reason, it's like I will buy and I'll go up like maybe $100. And then I leave it in there, and then the next day the direction completely change and go down, and I lose the money that I made in the first place. So for that reason, like this week, I'm like, I am not doing no swing trade, because anytime I did swing trades, I'll end up losing the money that I made.
Understood. So I think what's happening here is you're day trading, and that calls for different strategies. It means that you're expecting the completion of the whole, from start to finish, to happen within the same day. Is that right? You're not comfortable going overnight. Am I reading that correct?
Yes.
That's your strategy. Okay, so you're clearly day trading. That's a day trading strategy. And it means that you are more than likely not staying on the daily time frame. You're probably going down maybe to the 15-minute, or you're going to a lower time frame. What I would suggest is, so I use two time frames. I use the daily and the 15. The 15 when I'm doing a day trade, and the 15 when I'm doing a day trade, and the daily for swing trades. And I prefer just those two. Anything less than that, for instance, if you go over to the 1 minute, you will start making decisions that are wrong. Yeah. Because this is micro. So what I would say is increase the time frame, and also have a clear target. When you get in, you need to have a clear target. So you in my class, you already know the rules for entering the trade, right? So we have to stick to those. And if you go with a 60%, then once you reach that, take your profit. Yeah, take your profit. If you're close to 50% and you feel you want to take the profit, that's fine too. But 60% is roughly where we take the profit. So I think maybe your problem has to do with the time frame that you're using to trade, and you're just watching. It means that I have a feeling that once you open your computer and enter a trade, you don't walk away. Is that about right?
When I open my computer, say it again, I'm sorry.
When you enter a trade, you more than likely don't walk away. You're always watching it, right?
Yes.
Yeah. So we need I think we need a better trade plan. So let's talk about it on Thursday. How about that? Let's talk about it on Thursday night during the group session and see.
Thursday night.
Yeah.
I can do Thursday night. That's the problem.
Yeah. So yeah,
it's okay. Maybe Thursday morning I can prove a question, see if you got time to answer it before you drop.
Yeah, maybe Thursday morning, but Thursday night would be the better place where we can address this kind of thing. Where we want to get in with confidence. That's the main thing. When we build the trade, we're building one with confidence that gives you walk-away power. Yeah. So walk-away power is that ability to execute a trade and be confident that I can go get my cup of coffee, even if I'm a day trader, and then come back in 10 minutes. Yeah. Because watching it, as the paint, draws, as we draw those candles, that's going to force you to make some decisions real quick. So, yeah.
Okay.
All right, we've got a few more minutes here. Any other questions?
Hey, Eddie.
Yeah.
This is Antonia. Hi.
Hey, what's happening, Antonia?
Oh, nothing much. I think to what she was addressing, I had formed a bad habit of getting in the trade and watching it. So when I started with your class, I started following the rule of setting my bracket and my my target and walking away from it. And I did it in my sim with a swing trade. So that helped me to become more disciplined in and getting confidence in my trade. So maybe if she'll do some sim
sim trades, setting it with the swing trade, following what you said and walking away from it and practicing that. And that will help forming a better habit of watching it, because, you know, I'm a little bit nosy. I like to see what it's doing because
Yeah.
you know, but I've had to, you know, form better habits, and that helped with my risk management also.
Yeah, that's a good point, Antonia. So don't know whether you had that, Olga, is she is suggesting exactly that, which is a bracket order, which helps us. That's one of the tools that we use to give us confidence, because you know where your defined exit is and where your risk is. And once you're comfortable with that, then you can walk away. I would add to that the risk, because that's the one that we need to be more concerned about, that risk should never be greater than what your potential reward is. So a good example here is if you're expecting to make $1,000, then your risk should never be $1,000. It's never a one-to-one, should never be a one-to-one. So you don't want that. Instead, what you want is a reasonable at the furthest end of the spectrum, I would say a 2-to-1. So if you're expecting 500, make sure your risk is no more than 250, right? Something like that. The higher the risk reward, the better it is. I'm not saying that 2-to-1 is the best one. What I'm saying is that that's the worst that you should accept. Otherwise, we are always going for something really, really high. We're usually wanting to maybe risk 250 on a potential of 1,000, right? Or something like that. 3-to-1, 4-to-1, 5-to-1, those are good. 2-to-1 is the absolute worst. 1-to-1, no. Right? So she gave you an answer there, which is bracket order. That's one answer. Another answer could be go back to your trading plan. We've talked about that, and figure out ways to manage that. I think we're the same here. It's not just impatience. This is probably confidence. Yeah, confidence, because you're seeing the candle go the other way, and immediately you're panicking and believing that, no, this is turned around. I can't afford to lose this. I'm getting out. And then 2 minutes later, it turns around. So that's we have a few answers for how to solve that confidence by building close to an A+ trade, right? If it's an A+ trade, or even an A trade, then we don't have that issue too much. It doesn't go away. It never goes away. We just reduce that. Cool. All right, that brings us to about 12:30 Eastern time. Maybe just one more question and we are out of here. Let me see. So success, let's first recap. What does it take to stay successful? Discipline. You have to follow your rules, meaning that you have to have some rules, right? You have to have some rules for trading, and take your time to build them. You can build them in one day, that's fine, but you need experience to actually do your rules. So I would say, get some rules, stick to them, get an accountability partner. That one is strong. If you have an accountability partner, that's the person that you should be able to call, and they can tell you, dude, you're out of your mind. Don't do that. And they tell that to you in your face and in the most loving way that they can find. That's who you need. Somebody to tell you no. It's really hard to say no. Anybody know how to say no?
I'm great at saying no.
Yeah, Leslie knows how to say no. You push your tongue to the roof of your mouth, you blow the air, and the sound that comes out is no. Leslie, I want you to be my accountability partner. How about that?
I'm great at saying no. You may not like my no too often.
Yeah. Yeah. But the no needs to be reasonable, right? It needs to be
yes, I'm always reasonable, but I ask questions, and I think people don't like my questions. Why do you want to do this? Or why is it that you think you should do this? Not so much a no, but it makes people think, what's your motive behind your action. So then that way, if you're honest with yourself, you'll end up at your own no or at a better yes.
Better yes or a better no. Yeah. So yeah, I can already sense that Leslie is a good coach. She will make you find the solution, which is one of the hallmark of a good coach or a good teacher is the student is able to come up with a solution. And if you can come up with a solution yourself, you have more faith and confidence in it. So I like that. Leslie, you're my new coach. How about that?
All right. What's my discount?
$0.00. You're actually saving money. Did I already say that? You're saving money by buying now?
No, you did. You did. Trust me.
Yeah.
I'm on it, Eddie. I'm on it, Eddie.
Yeah. Very cool. No, it's Patrice says if it's my money, no, it's frequent. Yeah, that's yeah, that's true. Let me see. Any other questions up there? All right, I don't see any other questions up there. No other questions up there. So once again, options with Eddie. You can get in at a great investment right now. It's $3,500. It goes for 8 sessions at least, and you get a lot of perks with it. So it's not just 8 hours of intense training. It is more than that. You get a community. You get live trading. You get extended hours of support live, no additional cost. So all of that is what you get with options with Eddie. And it doesn't matter where you're coming from, what school you're coming from, or where you are in your options. You will. I found people who would benefit, even who've been trading for a year or 2 years. They still elevate, and that's the point. You want to move from where you are to greater consistency, greater discipline. Refine your strategies. That's all that we're looking for. So you're trading less, right? Keyword, you're trading a whole lot less, but you're making a whole lot more, a lot less stressful. You're being intentional when you make the profit, right? It's not just happen chance. You're not accidentally making any money. You're intentionally making. And when you risk, I don't use the word lose. When you risk, you're not risking anything that is going to destabilize your account. Is my training class 8 hours a day? No, it's 1 hour, 2 hours a week. So 2 times a week, one Monday and Wednesdays, usually. That's what Jennifer's asking. She's asking if it's 8 hours a day. That's a long time to. You're going to forget what you asked. I mean, what you learned in the afternoon, right? So, yeah, it's twice a week, Monday and Wednesday, 1 hour each time, and there's 8 sessions total. So most of the time, it's about an hour and 15 minutes, now 20 minutes each night, Monday night, Wednesday night. Cool. All right, guys, I am out of here unless anybody has a last minute question. I'm looking at the chat here. Looks like everything's good. The next class is on the 27th. On the website, it says 20th. That class is full. Keep the classes small. So the 27th, I'm going to update the website tonight. So 3.
I have a quick question.
Yes, ma'am.
Do you do like a one-on-one class? Like if somebody want to sign up for one-on-one class because the schedule don't work for them?
Yeah. I can do a one-on-one class. The cost is 10,000.
How much?
Just kidding. Yeah, we can do a one-on-one class. It costs a lot more because it means I have to dedicate time just for you. So for that, you want to contact me separately, and then we can talk about that. It's usually a needs-based, so I will have to evaluate whether it's even worth it for you or whether you'd benefit much better in taking a class. But in general, if you want a one-on-one with me, dedicated, just you and I, that would cost you a bit more.
Okay. I'm asking because of the people that are here with me, the time usually of the class doesn't work for them.
Yeah.
And so I always tell them that you can always do a one-on-one.
Yep.
So that was my struggle with the class. I never really get to finish because I couldn't, some of the classes I couldn't get on there because I was working.
Yeah.
So like when I'm talking to them, I always tell them that probably like the one-on-one class will work better for the schedule because that will be like a time frame that will work for them and for you too. So
yeah, and that's a possibility. It's not it's not out of the question. We can do a one-on-one or a specialized class. And I realize you're like what, a day ahead of us? Is that right? Something like that.
yeah, I'm like 12 hours ahead. Well,
Well,
what time is it? It's midnight 39. I mean,
yeah.
1:39 here.
Yeah.
Sunday morning.
Yeah, I've seen that problem before. So what we could do is, especially because of your time zone, I could make something for that time zone, and we can work something out. That way, you're not having to pay so much more. But on the other hand, is that all my classes are recorded,
Right.
and you have access to that for a lifetime. And
Mhm.
now, starting next month, it's going to be even better because you will have access to even more of my video library from other classes as well. So
Okay.
all that is coming up. But good question on that. Thanks.
Thank you.
Cool. All right, guys, I am out of here. Adios. We'll see you in a couple weeks. And let me stop sharing. There we go.
Bye, Eddie.
Thank
Y'all have a good week.
All right.
Thank
All right.
you.
Adios.
Thanks,
Right.
Eddie.
Thank you.
All right. All right. Bye-bye.